reported that Elon contacted Twitter's board and suggested that they move forward with closing the transaction at the original terms and the original purchase price of $54.20 a share. In the couple of days since then, and even as of right now, with some news reports coming out here on Thursday morning, it appears that there are still some question marks around whether or not the deal is actually going to move forward at $54.20 a share, because Elon, as of right now, the report said, is still asking for a financing contingency in order to close. And there's a lot of back and forth on what the terms are. Meanwhile, the court case in Delaware is continuing forward on whether or not Elon breached his terms of the original agreement to close and buy Twitter at $54.20. As we know, leading up to the signed deal, or post signing the deal, Elon put together a financing syndicate, a combination of debt investors as well as equity co-investors with him, to do the purchase of Twitter at $54.20 a share. So the 40 some odd billion dollars of capital that's needed was committed by a set of investors that were going to invest debt and equity. And there's a big question mark now on whether or not those investors want to or would still consummate the transaction with Elon, given how the markets have turned and given how debt markets are trading and equity markets are trading. So Chamath, I'd love to hear your point of view on what hurdles does Elon still have in front of him. Does he still want to get this done? And is there still a financing syndicate that's standing behind him at the original purchase price to get it done?
It's a great question. Maybe the best way to start is, Nick, do you want to queue up what I said in August 25th?
The lawsuit really boils down to one very specific clause, which is the pinnacle question at hand, which is there is a specific performance clause that Elon signed up to, right? Which, his lawyers could have struck out and either chose not to or, couldn't get the deal done without. And that specific performance clause says that Twitter can force him to close at $54.20 a share. And I think the issue at hand at the Delaware Business Court is going to be that, because Twitter is going to point to all of these, gotchas and disclaimers that they have around this bot issue as their cover story. And I think that really, this kind of, again, builds more and more momentum in my mind that the most likely outcome here is a settlement where you have to pay the economic difference between where the stock is now and $54.20, which is more than $1 billion, or you close at some number below $54.20 a share. And I think that is like, if you had to be a betting person, that's probably, and if you look at the way the stock is traded, and if you also look at the way the options market trades, that's what people are assuming, that there's a $7 to $10 billion swing. And if you impute that into the stock price, you kind of get into the $51 a share kind of an acquisition price. Again, I'm not saying that is right or should be right. That's just sort of what the market says.
Yeah. So it turns out that, sort of like that kind of guesstimate turned out to be pretty accurate, because the stock today is at $51 a share. So I think that the specific performance thing is exactly what this thing has always hinged on. And I think that there was a realization that there were very few outs around how that contractual term was written and agreed to. So there is an out in the contract. And that out says that, I think it's by April. If the deal doesn't get done by April, then the banks can walk away from their commitment to fund the debt. And if the banks walk away, then Elon does have a financing contingency that allows him to walk away. So the actual set of events that have to happen is those two things specifically. Get to April so the banks can pass and say, we've changed our mind, market conditions are different. And then Elon is able to say, oh, the banks just walked away. Right now, the banks, if you look at all of the debt that they've committed to, well, they committed at a point in time when the debt markets were much better than they are today. In the last 6 or 7 months since they agreed to do this, the debt markets have been clobbered. And specifically junk bonds and a bunch of junk bond debt, the yields that you have to pay, so the price to get that kind of debt has skyrocketed. So roughly back of the envelope math would tell me that right now the banks are offside between $1 and $2 billion, because they're not going to be able to sell this debt to anybody else. So I think the banks obviously want a way out. The problem is their only way out is to run the shot clock off until April. So I think that's the dance that they're in right now. Elon's trying to find a way to solve, for the merger. I think Twitter's going to say, we're not going to give you a financing contingency. You have to bring the banks in and close right now. And then we will not go to court. Otherwise, we're going to court. And so I think it's a very delicate predicament that they're all in. But my estimate is that the equity is probably 20% offside. So it's not a huge thing. He can make that up because he can create equity value like nobody's business. The debt is way offside by a couple $2 billion, which is hard to make back. But I think in the end, given enough time, they can probably make that back. The best off in all of this are the Twitter shareholders. They're getting an enormous premium to what that company is worth today in the open market. And so I think this deal is going to close. It's probably going to close in the next few weeks. And had you bought Twitter when we were talking about it in August, you would have made 25% in 6 weeks. And, if the deal closes at 54, you would have made, a third of your money in 8 weeks, which is, very hard to do in a market.
If you're
like
a GP at one of the funds like Andreessen or Sequoia, and you had made this commitment to Elon or even Larry Ellison a couple months ago, do you fight against closing at 54.20? Do you stick with the deal and support him? I mean, what do you do given that the premium is so much higher than where the market would trade it at today? Some people are saying the stock should be at like $20 a share or something.
The average premium in an M&A transaction in the public markets is about 30%. So, and I think the fair value of Twitter is around $32 to $35 a share. So, it's not like he is massively overpaying. And so, I would just sort of keep that in the realm of the possible. So like if you take $35 as the midpoint, fair value is really $45.50. So yeah, he paid 20% more than he should have, but he didn't pay 100% more. So it's not as if you can't make that equity back as a private company, particularly because there's probably $10 of fat in the stock if you think about just OPEX.
Right.
In terms of all the buildings they have, maybe they don't need as many employees. Maybe they revisit salaries. One thing is when I looked at doing an activist play at Twitter, I think I mentioned this 5 or 6 years ago. One of the things that I found was at that time, Twitter was running their own data centers. And, the most obvious thing for me at that time was like, we're going to move everything to AWS. Now, I don't know if that happened, but I'm sure that if it hasn't, just bidding that out to Azure, GCP, and AWS can raise, $3 or $4 billion because I'm sure those companies would want this kind of an app on their cloud. So there's all kinds of things that I think Elon can do as a private company to make back maybe the small bit that he overpaid. And then he can get to the core job of rebuilding this company to be usable, or this product to be usable. Because look, I'll just speak as a user right now. It has been decaying at a very, very rapid clip. And I think that his trepidation in closing the merger, in part also, even though he hasn't said it, has to do with the quality of the experience. It's just degraded. It's not as fun to use as it was during the pandemic or even before the pandemic. So something is happening inside that app that needs to get fixed. And if he does it, he'll make a ton of money.
Sort of like what happened with Friendster and MySpace and any social networking app over time, the quality degrades. If it's not growing, it's shrinking. And it gets...
If it's not growing, and also if the product hygiene isn't enforced in code, and product hygiene in this case are the spam, bots, the trolling, it can really take away from the experience.
Yeah. I mean, interestingly, like if you think back to the starting days, the original days of Twitter, I don't know if you guys remember, you would send in an SMS to do your tweet, and then it would post up, and other people would get the SMS notification. And it would crash all the time, and the app was notoriously crashing. It was poorly architected at the beginning, and some people have argued that Twitter has had a cultural technical incompetence from the earliest days.
I think that's a little harsh. So I do think, look, Twitter was known for what's called a fail whale. They used to have these fail whales constantly, and they did hire people that attempted to try to fix it. I remember the funniest part of when I went in there and said, hey, here's my plan and here's what I want to do, is literally a day or two later, the head of engineering quit. I can't remember who his name was, but he was just out the door. But I think it is a team that has tried its best, that probably at the edges definitely made some technical miscalculations. Like I said, at that time, the idea that any app of that scale would use their own data centers made no technical sense whatsoever. It made the app laggy. It made it hard to use. It made it more prone to downtime, to your point. But that being said, I would be shocked if they haven't made meaningful improvements because the stack of the internet has gotten so much better over the last 7 years. And so, to your point, David, if they didn't take advantage of all these new abstractions and mechanisms to rebuild the app or to rebuild search or to rebuild, how, all these infrastructure elements of the app work, I would be really surprised because then what are they doing over there?
Yeah. Well, look, I mean, to the point earlier, besides the product points, there was a really good tweet I liked that said, for what it's worth, I think Elon will show us just how lean these Silicon Valley advertising companies can be run. At the very least, it'll be an interesting thought experiment for spectators. Because if he does go in and actually does significantly reduce OpEx and headcount, and the company does turn profitable and he can grow it, well, look, it'll really, by the way, it'll really be a beacon
from a
some of these
financial
other big companies. Yeah.
From a financial perspective, there is $10 a share in OpEx cuts that he should make right away, just so that he is economically break even and he looks like every other M&A transaction. You paid a 30% premium and you bought a company. There's a lot of margin of safety there if Elon does that. So to your point, there probably is, and there probably needs to be a meaningful riff at Twitter. I'm not saying it's right. I'm not saying it's, and I feel for the people that may go through it, but from a financial perspective, the math makes sense for him to do that because then he is a break-even proposition on a go-in M&A transaction. And I think that there's a lot of intelligent financial sense so that all the debt holders feel like he's doing the right thing and all the equity holders particularly see a chance for them to make a decent return here.
All right, well, let's move on. This has been a great conversation. A great conversation between Chamath Palihapitiya and Dave Friedberg about the Twitter transaction. And now we're being rejoined by our besties who are
by other besties.
Yeah. How was your cappuccino, JCal?
That was great. I have a nice cold brew here, a nice iced cold brew, and a nice drip coffee. I'm working both.
I'd love to talk about topics that I'm not being subpoenaed or depositioned about.
We will have a lot to say in the coming weeks.
I'd love to talk about topics that my lawyers have advised me not to talk about.
Brutal.
How eerie was our prediction? $51 a share, and it is exactly where the stock is right now. That's eerie.
Yeah. All right. Lots of advances.
No comment. Let's keep going.
Yeah. Speaking of Elon, Tesla AI Day was last week. I actually went. It was great. This is a recruiting event where
what did you do after?
Phil Hellmuth and I went and I drove Phil Hellmuth home. The end. No, it's a great event, and it is essentially a giant recruiting event. Hundreds of AI.
I'm sorry. Can we just talk about Phil Hellmuth's non sequitur in the group chat about Ken Griffin?
Where he's just like, I made a joke about his net worth, and he responded.
What is going on? We were talking about the most serious of topics, and he just comes
7 seconds to Phil. Is what's going on. 7 seconds to Phil.
By the way, I was texting with Daniel Negreanu. He did an incredible podcast. If you guys, with Lex Friedman, if you haven't listened to it, the Daniel Negreanu pod with Lex is incredible.
Oh, I gotta watch it.
But I was joking with Daniel that there's a section where he's talking about the greatest poker players of all time. And if you look in the bar of YouTube, it shows where the most viewership was. And it was exactly the 30 seconds he talks about Hellmuth. And I said to Daniel, this must have been Phil rewatching it over. And
I put it on loop. He went to bed with it like it was ASMR to put him to bed.